I think right now, I mean, the unpopular view in the market, I think regional banks are actually pretty cheap in the U.S. and no one really wants to own them, but they're cheap, and I think that they are probably going to surprise the upside over the next couple of years in terms of performance. I think that Bitcoin is cheap right now. I think it's probably got a good 2 year performance ahead of it. I think that energy is cheap. Energy infrastructure, energy producers, I think those are cheap. I think certain Latin American, Indian assets are inexpensive and are pretty well positioned.
Even in an economy that appears stable on the surface, Lyn Alden suggests that the forces shaping today's financial landscape have been building for decades and they're nowhere near finished. Structural deficits, shifting monetary cycles, and demographic pressures create a backdrop in which certain assets thrive, even as everyday households feel squeezed. In this environment, gold, silver, real estate, and Bitcoin stand out not because of short-term excitement, but because the long-term currents continue to push capital toward them. She explains that despite fears about failed Treasury auctions, the system is designed to prevent such breakdowns. Primary dealers are obligated to buy, and if their capacity becomes stressed, the Federal Reserve can step in, absorb Treasuries, and restore liquidity. Historical examples such as the 2019 repo spike or the 2022 UK gilt crisis show that sudden liquidity issues are typically resolved quickly with targeted money creation. These interventions may relieve immediate stress, but they also extend underlying imbalances rather than fixing them. Lyn Alden notes that the consequences of decades-long policy choices are already visible. While markets show strong performance, the median household struggles, reflecting mounting structural pressures. She believes meaningful breaking points are unlikely before the 2030s, when major entitlement programs reach critical funding decisions. Until then, governments can keep kicking the can, though not without societal cost. Rising political frustration on both the left and right stems from deep issues: demographics, entitlement structures, and decades of accumulated fiscal burdens that voters rarely connect to long-term systemic problems, even as those strains steadily intensify. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
Yeah, good question. I mean, I think the macro conditions that fuel this type of thing are going to be going on for quite a while, many, many years. I would say we're in a state of fiscal dominance in the United States as well as many other developed countries. And so basically, we have very large structural deficits as far as the eye can see. We're probably shifting from a period of kind of monetary tightening to monetary loosening in the coming months. And individual assets can get ahead of themselves from time to time. I think that gold and silver, while attractive, are now getting somewhat, overbought in maybe the tactical sense. I don't view them as structurally overvalued. And so I think, some combination of equities, real estate, precious metals, Bitcoin, these kind of assets, they have their, individual years in the sun. But I think that continues to be the kind of assets that investors want to own over the long term. Not in the short term, no. So prime dealers are pretty much required to bid, and whenever they get too full, that's where the Fed bids. The Fed can, but they can buy treasuries from them and basically refill their liquidity. So I don't really see that anytime in the kind of investable time horizon. Now, you could have a technical glitch of some sort or some sort of like kind of liquidity pop, like we saw, for example, in September 2019. There was that repo spike, which, by the next day they printed money and put out. So a lot of these little issues can be resolved by printing money. You get these little fires that pop up. I mean, people probably remember the 2022 UK gilt crisis. That was a little mini crisis that happened. They put it out with a little bit of money printing. And it's not, obviously the UK has issues now economically. And these things, they keep getting put out by, you put out the immediate fire with a little bit of money printing and you kick the can down the road. And I think the US is going to keep doing that. So no, I don't view a kind of a persistently failed auction as anything that's like investable. I'd say one is that there's already a problem. It already impacted. I mean, that's why like voter sentiment, consumer sentiment, both for the prior administration and the current administration are low because the core issues are just not being tackled. And that's why, despite the fact that stocks are up and gold is up, the median household in the U.S. is struggling. And so it already matters. We're already paying the price for these policies. But that doesn't mean it stops, right? So the second answer to the question is I think not for a very long time. Like I think earliest is 2030s. But it could go on a lot further than that. That's kind of where certain big decisions get made. For example, the Social Security Trust Fund runs out in the mid 2030s, so that'll be kind of an interesting decision point to see how they handle that, because that has various political ramifications. But between now and then, I think they will keep pushing this down, and they will keep paying the price for it. It's not a costless can kicking. Um, and a lot of people when they think of like things like failed auctions or crises, they often look at this in a vacuum. I mean, I spend part of each year in Egypt. They were dealing with, it was a couple years ago, it was 38% inflation. Um, uh, and the currency crises all over the place and issues like that. They weren't having failed bond auctions. It's like there's the U.S. Like we consider 9% inflation an absolute crisis. Many parts of the world, that's like a normal Tuesday. Um, and these systems can, often keep the wheels on the cart more than you'd think. And the U.S. has a lot of runway. But what snaps, I think, is before the numbers snap. I think the politics snap in the sense that you have these kind of rising populism, both on the left and the right, uh, increasing discontent with how things are going. No one's really, because it's a complex topic. No one talks about Triffin's dilemma when they're talking like angry about politics, and no one's talking about, when they think why if the deficit's so big, people say is it Trump's fault or Biden's fault? No one says, well, maybe we're still paying interest on the Iraq War from decades ago, or maybe we didn't set our entitlement systems up well decades ago, and that they're basically very top heavy now because they always expected to have the next generation be larger than the current generation, and none of these systems make sense when you get a generation that's smaller than the prior generation, and people live longer. So you have these kind of structural issues that have been building for decades. And so you get these kind of rising problems. But then, yeah, whenever you do have a little mini crises, um, they can put it out for a good period of time and keep pushing it.
Lyn Alden explains that the debasement trade has only recently entered mainstream finance, even though many investors have been discussing it for years. Large institutions are now openly acknowledging currency debasement and sovereign debt risk topics that were almost taboo a decade ago. Much of the easy money from this trend has already been made, as assets like Bitcoin, gold, and equities rose substantially while bonds lost value. Going forward, she expects the dynamics to continue but at a more selective pace. Equities may still outperform bonds over time, but high valuations make broad index buying less attractive. Instead, she favors assets with genuine scarcity or enduring moats, things that cannot simply be printed or replicated, while being mindful to avoid bubble phases and overpriced names. She also highlights several areas she considers undervalued in the current market. Regional banks, despite being unpopular, appear cheap and may surprise to the upside. Bitcoin, energy producers, energy infrastructure, and certain emerging market assets, particularly in Latin America and India, offer attractive long-term setups. Not all of them will perform equally, which is why she prefers a diversified approach that can absorb temporary disappointments. But overall, she believes these pockets of value sit in favorable positions and are unlikely to face major systemic risks within the typical investing timeframe. Let's get back to the interview.
Well, yeah, so the debasement trade is a term that became popular just recently. It's funny because many of us have been talking about it for quite a while. Um, I mean, basically, it's like you have. I think what's new is that large institutions are talking about debasement and talking about the risks of sovereign debt, which would have been unthinkable a decade ago, pretty much. Um, and so it's kind of the mainstreaming of concerns that many investors have had for quite a while. And in some cases they're late to the party. I mean, basically, when people were talking about that when Bitcoin was worth a tenth of what it is now and gold was worth a third of what it is now, and stocks were half of what they are now, and bonds were worth, 50% more than they are now. Um, a lot of the money was already made in the past 5, 6, 7, 8 years of just being on the right side of all this debasement. If anything, I think some of it could slow down in the sense that because of how high stocks are priced, I'm less confident that they're going to outperform bonds over the next 3 to 5 years. If you like, in 2019, I was like, sure, stocks are a little expensive, but I'd much rather own them than bonds. Um, and they absolutely killed bonds in that period. Now going forward, I view it. I still lean toward equities over bonds, but I'm a lot more picky on what equities because if you have like I used Costco as an example. They were trading at 55 times earnings earlier this year. Now they're in the upper 40s. Nothing really stops that from potentially going down to 30 times earnings. And so even if bonds get debased, you can still have very high flying equities just kind of roll over and sag. You take on that risk at least. So I think you want to be picky about valuations, and that it's less clear that you just buy a stock index over a bond index. But I still, in general, you still want to be structurally long things that are scarce, meaning that they're resistant to being eroded by AI. They're resistant to just printing more and more of that good. So if you own currency, it's like a good that can just be printed. If you own bonds, they're just printed. But if you own gold, you want to avoid buying into a bubble spike, and kind of make sure your timelines and volatility is in check. But you don't have to worry about money printing per se. And the same thing is true for other kind of assets that have an economic moat, a network effect, something that kind of keeps them scarce, pretty durably scarce, while also being not a very crowded trade. So assets that are on average underowned or average owned, and that are going to be in demand for 5, 10, 15 years in the future. I think right now, I mean, the unpopular view in the market, I think regional banks are actually pretty cheap in the U.S. and no one really wants to own them, but they're cheap, and I think that they are probably going to surprise the upside over the next couple of years in terms of performance. I think that Bitcoin is cheap right now. I think it's probably got a good 2 year performance ahead of it. Um, I think that energy is cheap. Energy infrastructure, energy producers, I think those are cheap. Um, I think certain Latin American, Indian uh, assets are inexpensive, and are pretty well positioned. And I think, looking back 2 years from now, I think, some subset of that will probably have disappointed, and another big subset will have probably done well, which again is why I want to spread my bets out so that, I can take a hit on an asset that has been a little bit disappointing. For example, the past 2 years, energy producers and service companies have been kind of disappointing after a really good run in 2022. Um, but generally thinking, there are these pockets that are still attractively priced, and that I don't think are going to be hit by major crises in the next kind of investable time horizon.
A world where persistent currency pressure, structural deficits, and shifting monetary policy continue to shape how capital flows. The momentum behind the debasement trend hasn't vanished, but it has matured into a phase where broad, indiscriminate buying is no longer enough. Assets that cannot be printed, easily replicated, or replaced by technology remain the most resilient, while overstretched equities and conventional fixed-income instruments face growing vulnerability. At the same time, several overlooked areas, regional banks, energy producers, energy infrastructure, Bitcoin, and select emerging markets offer meaningful value for investors willing to look past market sentiment and focus on long-term fundamentals. Navigating this landscape requires patience, diversification, and a clear understanding that the forces driving investors towards scarce, under-owned assets are still very much alive, even as the cycle becomes more nuanced and selective. How might the next phase of monetary easing or continued fiscal strain reshape which scarce assets outperform, and could today's undervalued sectors become the core leaders of the next investment cycle? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support, and we hope you enjoy the video.